I am Mohini. Today we'll discuss sales variance analysis. What is sales variance analysis? Let us see the meaning. A sales variance is the monetary difference between actual and budgeted sales. It is used to analyze changes in sales levels over time. There are two general reasons why a sales variance can occur, which are the price point at which goods or services sell is different from the expected price point. For example, an increase in level of competition forces a company to reduce its prices. This is known as the selling price variance. Then next, the number of units sold varies from the expected amount. For example, a company begins selling in a new region and expects to sell 1 lakh in its first year, but only sells 80,000 units. This is known as the sales volume variance. These two reasons for a sales variance can interrelate. For example, management may decide to keep the budgeted price point throughout the measurement period despite the price being clearly higher than that of competing product. The result is no sales variance due to price, but a large negative variance due to the number of units sold being far lower than expected. Management typically pays considerable attention to these components of the sales variance in order to see if prices, product features, or marketing must be adjusted to optimize total sales and profits. Here are several actions that can be taken. Issue a limited time coupon offer that is effectively a price cut. This approach will reduce short term profits on a per unit basis, but should increase the number of units sold. Cut back on the number of product features and sell the product at a lower price point. This approach can boost volume while still retaining a profitability. Reposition advertising to show a product as high end, which may allow for a price boost. A sales variance can be caused by corporate strategy. For example, management may decide to keep prices low in order to deter potential competitors from entering the market. If so, and the budget does not reflect this strategy, there could be a large sales variance. Sales variance, here let us discuss the formula and all this. In order to take the full advantage of budgetary control system and standard costing techniques, nowadays a good number of companies are interested to calculate sales variances so that the effect of change in sales volume and prices on profit can be assessed properly. This variance can be computed in two forms, namely the turnover or sales or the value method. Second one is the profit or the margin method. The turnover or the value method means what? It has already been pointed out earlier that sales variance is computed in order to ascertain the effect of changes in sales and price. We also know that changes in sales may be made due to change in selling price, change in volume, and change in sales and mix. Now, the sales turnover or turnover volume variance may be analyzed as under. So, we can classify into mainly two headings: sales or value method variance can be classified into two mainly: price variance and volume variance. Again, volume variance can be subdivided into quantity variance and mix variance. Then, what is sales value variance? This is the difference between the actual sales and the budgeted sales. It is similar to material cost variance and labor cost variance. If actual sales are more than the budgeted sales, there will be favorable variance and vice versa. In the opposite case, sales value variance equal to actual sales minus minus budgeted sales, where budgeted sales equal to budgeted quantity into standard selling price. Then sales price variance. It is the difference between the standard price and the actual price of sales. If actual selling prices are more than the standard prices, there will be favorable variance and vice versa in the opposite case. Sales price variance equal to actual sales minus standard sales, where standard sales means actual quantity of sales into standard price, or actual price minus standard price into actual quantity. Now let us see second one in the second sub one, sales volume variance. It is that portion of the sales value variance which is due to the difference between the budgeted sales and the standard value of actual sales mix. If actual sales at a standard price is more than the budgeted sales, there will be favorable variance and vice versa in the opposite case. Sales volume variance equal to standard sales minus budgeted sales, or actual quantity minus standard quantity into standard selling price per unit. It has already been shown in the earlier that sales volume variance can further be subdivided into quantity variance and mix variance. The former, namely quantity variance, expresses the difference in the value of sales where actual sales mix is different from what was expected in the budget mix. Similarly, the latter expresses the effect of total quantity, whether more or less than the budgeted quantity. Now let us see sales quantity variance. It is the difference between the budgeted sales and the standard sales of the revised standard mix of sales. There will be a favorable variance if revised standard sales are more than the budgeted sales and vice versa. Therefore, sales quantity variance equal to revised standard sales minus budgeted sales, where revised standard sales means total standard sales into budgeted sales for each product, or total divided by total budgeted sales, or actual sales quantity minus budgeted sales quantity into standard selling price. Like this also we can calculate. Now sales mix variance. It expresses the difference between the standard value of the standard mix of sales and revised standard value of actual mix. If standard sales are greater than the revised standard sales, there will be favorable variance and vice versa. Sales mix variance equal to standard sales or standard value of actual sales minus revised standard sales. Now we'll go to the next second one, second main variance, profit variance. In order to show the effect of changes in the volume of sales or selling price on the profit, it becomes more important to analyze the profit variance to the management of the concern. The profit variance can be expressed in like this. Profit variance or total sales margin variance can be divided into two types, mainly profit variance due to selling price or sales margin price variance. Next, profit variance due to the sales volume or sales margin volume variance. Again, this can be sales margin volume variance can be subdivided into two. Profit variance due to quantity or sales margin quantity variance, and profit variance due to sales mix or sales margin mix variance. Now let us see what is that. Profit variance or total sales margin variance means it is the difference between the standard margin to the quantity of sales budgeted and the margin between standard cost and the actual selling price of the effected sales. That is the difference between actual profit margin and budgeted profit or margin. So, profit variance equal to budgeted margin or profit minus actual margin or profit, where actual margin means actual sales minus standard cost of goods sold. Now we'll see sales margin price variance. It is the difference between the standard price of the quantity of effected sales and the actual price of those sales. So sales margin price variance is equal to actual sales margin minus actual number of units sold into standard margin, or actual profit minus standard profit, or it can also be calculated using this formula: actual quantity sold into the difference between the standard price and the actual price. So next we will go to sales margin volume variance. It is simply the difference between the budgeted quantity and the actual quantity of sales. Sales margin volume variance equal to actual number of units sold minus budgeted sales into standard margin per unit, or standard profit minus budgeted profit, or it also can be calculated using this formula: the difference between actual units sold and budgeted sales into the standard margin per unit. Now we'll go to the next, sales margin quantity variance. It is the difference between the budgeted margin and the actual quantity of standard margin per unit of standard mix. So sales margin quantity variance equal to standard quantity minus actual quantity into standard margin per unit, or it also can be calculated using this formula: the difference between revised standard profit and the budgeted profit into sales margin mix variance. It is the difference between the budgeted and actual quantities of each product by which the sales mix is constituted, and sales should be volume at standard selling price while cost of sales at standard price. So sales margin mix variance equal to revised standard profit minus standard profit, or actual number of quantities sold into the difference between standard margin per unit of standard mix and the standard margin per unit of actual mix, or it also can be calculated using this formula: standard proportion of mix minus actual mix into standard margin. Now the variance that we have discussed so far can be expressed either in absolute figures, or in percentage, or in ratios. There are certain other important ratios which help a firm to assess its capacity utilization, labor, material, and other reasons that are required by the top management for taking decisions. They are helpful to gain the overall performances of the business. Some of these are discussed here. First, let us see efficiency ratio. It can be defined as the standard hours equivalent to the work produced expressed as a percentage of actual hours spent in producing that work. So, efficiency ratio equal to actual production expressed in standard hours, or actual hours worked into 100. Then second one is activity ratio. It is defined as the number of standard hours equivalent to work produced expressed as a percentage of the budgeted standard hours. It measures the level of activity at which the firm is operating. Activity ratio is equal to actual production expressed in standard hours, or budgeted production expressed in standard hours into 100 or 100. Then disposition of variance. Since there is no hard and fast rule regarding the disposal of cost variance, difference of opinion arises among the accountants. Thus, the method which will be followed depends on the accountant's attitude and the practice that is followed by the firm. However, the following methods are usually applied. Let us see. First one is transfer to the current year's income statement, allocating variances as part of the cost of goods sold and inventories, setting up as a reserve. Then let us see what are the transfer to current year's income statement means. What is this? In this method, the unfavorable variances are debited to profit and loss account, whereas favorable variances are credited to profit and loss account. Thus, the net effect is adjusted against the gross profit accordingly. Needless to mention that if net variance is a favorable one, it will increase the amount of gross profit figure, and similarly, if the net variance is an unfavorable one, the same will reduce the gross profit. Second explanation is allocating variances as part of the cost of goods sold and inventories. Under this method, cost variances are allocated among work in progress, finished goods, and cost of sales on the basis of units of value. Thus, the work in progress, finished goods, etc. are shown at actual cost. Although this method is a simple one, the same is not always followed. The last one is setting up as reserves. Under this method, the variances are set up as a reserve until the same are set off. For instance, variance losses will be carried forward until there happens a corresponding variance gain. But the most suitable one for disposal of variance is if the variance arises either due to the incorrect standard or uncontrollable condition, the same should be allocated to work in progress, finished goods, and cost of goods sold. But if the variances arise from an uncontrollable situation, the same should be transferred to profit and loss account accordingly. So far, we have discussed sales variances. Now we'll solve some problems and some advanced problem in next videos. So until then, we'll take um, away from ourselves. Thank you. Have a good day.